Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
All right, well, shares of Whirlpool are trading higher today. This is the company that owns the Maytag and KitchenAid brands. Had its annual investor day and shared how it's counting on small appliance businesses to help turn around sales. Whirlpool shares up by 0.6% right now.
All right, so let's talk a little bit about strategy and the business outlook and how the consumer is doing. Let's get to the interview. Great to have back with us Whirlpool Chairman, President, CEO, and COO Marc Bitzer. He's joining us from the New York Stock Exchange, where he presided over the company's investor day. Marc, so good to have you back with us. Hope you are well. Let's start a little bit broadly, because we got some U.S. consumer confidence news down in February for the first time in 4 months. Americans' views deteriorating about the outlook for the company, the job market, and financial conditions. What signs of strain and stress are you seeing specifically when it comes to consumers? How would you describe them?
So Carol, first of all, thanks for having me back on your show.
Yeah.
Let me maybe talk, obviously our purchase like a durable appliance is heavily driven by consumer confidence and housing in general. So what we did see already the last year is that actually our replacement side of a business, where people just replace a product under duress, that has been very strong and even up. But the discretionary side, we actually already last year saw coming down. Largely as a result of interest rates rising, housing kind of being very slow and slowing down throughout the year, that ultimately depressed the discretionary side. So what you're describing, we saw already last year, and we probably, in our earnings call also, we said it's probably going to be around us, certainly for Q1 and Q2. And then we need to see what happens with interest and mortgage rates and everything else. But I think there needs to be a catalyst from that side to really lift consumer sentiment.
Well, what would that catalyst be, Marc? Like, what are you looking for at the perch of Whirlpool?
Yeah, in particular for our North American business, which, there's a strong correlation with existing home sales and housing market in general. We shouldn't forget that, the average mortgage rates, which are right now locked in with homeowners, is 3.7%. So I think to really bring supply on the market and getting people ready to sell their existing homes, I think you need to see mortgage rates, certainly below 6%, probably more like 5.5%, to really kind of unfreeze the market again. Because, what we saw the last 2 years is the market pretty much dropped from 6.4 million existing home sales to 3.8. That's a dramatic drop. We call it a shock freeze. And it takes that momentum or the catalyst on the interest rate side to kind of unfreeze or fall the market. And that's what we don't see it short term. And of course, everybody's got to watch what the Fed will do. But I think over time, it will kind of be a key catalyst for growth.
So make that connection for our investor audience about that key catalyst here and why a person who is sitting at a 3.75% mortgage won't necessarily go out and buy a new appliance from Whirlpool. But if they were to sell that home to somebody at a favorable mortgage rate, that person moving in would then buy a new appliance from Whirlpool. Why wouldn't the person who lives there now end up buying it if they actually need a new washer or dryer?
Yeah. So again, if it just need a new washer and dryer, we would see that as a replacement market. And it's again, if you break down, and let me zoom out a little bit, break down our fundamental demand. Our demand has replacement, has discretionary, and new homes. These are basically our fundamental three demand drivers. Replacement is very strong because what we've seen post-COVID, and certainly during COVID, people spend more time at home. So the appliance usage is higher. Higher usage rates drive earlier replacement. So that side of business is very strong, and we see that today. But what is right now soft is the discretionary side, which in particular comes with existing home sales. And over many decades, what we typically saw kind of the month before and the month after people buying a new home or existing home, that's when you have increased purchase and appliance and everything. So because what we typically see with people moving in, one of the first things we might do is replace the kitchen or at least replace the appliances. So that part of the demand is today missing. And again, think about yourself. If you're a homeowner, you're locked in at 3.7 rate. Are you willing to kind of refinance or buy a new home where mortgage rate right now is 6.8 or 6.9%? The chances are low. Okay, that's right now what we see in the market, and you can't blame the consumer for that.
Mark, I feel like you're describing me. You know, we bought a new hot water heater because we had to. We didn't have a choice, right? That was replacement. We thought about maybe purchasing something else new that we didn't need to and discretionary, and we said, you know, we're going to not do it right now. So, like, I totally get what you say is going on. Having said that, then, let's talk a little bit about your Investor Day and some of what you're doing. Our team writing up how you guys are going to focus are focusing on smaller appliances. It seems to be maybe what consumers are willing to spend money on. The margins are better. Talk to us a little bit about that strategy and how it can move the needle, especially when it comes to top line growth and margin growth.
Yeah. So Carol, what we spoke about is, you know, as a company, we've been in a multi-year, what we call portfolio transformation. And what it basically meant is, over past decades, we've had a fairly dispersed global business. We were from China to Chile, in all places of the world. And what we've decided on the majors business, but we want to focus on the markets where we have an undeniable strong position, which are for us the Americas, North America, South America. We have good business in India, and that's what we'll focus on. So over the years, we sold off the majority of our China business. We sold off Russia. And right now, we're just in the kind of final weeks before we can close our European transaction, where we would only have a smaller portion of the business. So with that, we have a fundamentally different business portfolio. One, essentially, it's the major business in the Americas and India. And we have our small domestic appliance business. That was, in some ways, you could describe it as a hidden gem from the past, because it was hidden in the segment results of all the different regions. But if you look at that, that is probably, it's our strongest brands. It has passion across all demographics and age groups. And we feel we have a license to grow that business, certainly from a consumer perspective. So, and a lot of our resources going forward will go into our small domestic appliance business, because it's certain one which we love, strong margins, and an exceptionally strong consumer position.
How small, or what percentages is the smaller appliance business, Mark, right now in terms of revenues, and how big do you think it could become if we look at the kind of revenue pie?
Yeah, so today it is quote unquote only a $1 billion business, but it has 50% EBIT margin. So it's a very margin attractive business. But you know, our presence if you look at the categories of small domestic appliance, it's largely stand mixers and associated products. But we have so much opportunity to grow in coffee, and we just announced today also we will bring a fully automatic espresso maker in May this year. In other parts of business. So we strongly believe there's ample opportunity to grow that business.
Hey, I want to talk a little bit about the cost cutting that you're targeting right now across the different business lines after incurring significant increases back in 2022 and in 2021, Mark. Where within the business are you finding these savings?
Yeah, so first of all, to put it in context, is, you know, in the COVID years, we basically had more than $2.5 billion of additional costs. That was the big inflation wave, not only raw materials in all parts of the business. Last year, we clawed back 800 million of that, and this year we're targeting over 500 million. So we're not even fully back to pre-COVID cost levels. The opportunities which we see this year, and that's a little bit different from last year, we don't see a lot of tailwinds from raw materials. So we pretty much expect steel and oil and everything else to remain rather stable for us. But we do see opportunity on cost takeout on products. We do see further opportunities to reduce logistic costs, because it's a massive cost element for us, because we're shipping big, bulky products, and that just drive a lot of cost on the logistics side. But we're also looking at our overall, call it overhead and infrastructure. And what I mean with that is, you know, global business required a fairly complex global organization. With a more focus on our Americas, we have an opportunity to radically also simplify how we organize, and that also drives some cost savings.
I do wonder, too, looking at your balance sheet, we have this really great story, a Bloomberg exclusive today. It's among our most read, about how companies who have been so addicted to debt are now seeking equity. So thinking about selling shares rather than tapping the debt markets if they need money. You guys, what's your plan to deleverage your balance sheet specifically, which has grown as you've done some acquisitions? And I do wonder if investors can kind of still count on the dividend going forward, the sustainability of the dividend, Mark. And just got about a minute or so left.
Yes. So let me first start straight away with dividend. We paid our dividend for 69 years, 69. And in none of the 69 years, we ever had a dividend reduction. Actually, out of the last 10 years, in 8 years, we had a dividend increase. So we We are
So that's a
strongly
yes?
committed. Yeah, that is well, of course, every single dividend payment requires a board approval, but
Right.
I would say this statement publicly if I don't feel the board feels very strongly about it. So we strongly believe in dividend, and we have a funds to pay the dividend, and more importantly, we have a guideline internally where we say, over the last 3 years, we look at the average EPS, and we typically pay out 35% of that EPS over the last 3 years, and we're pretty much on track on this one. So more to the balance sheet is, first of all, keeping us in mind, we have $1.6 billion of cash on hand.
Right.
That's a public number. So what we do want to do, and we knew exactly when we acquired the incinerator business in Wisconsin, which is hugely margin attractive with a strong position. We knew, of course, it's a heavily loaded balance sheet, and we said we need 2 or 3 years to kind of digest that acquisition-related debt. We paid last year down $500 million. We will pay down this year $500 million. So what we guided today in Investor Day is kind of, by 26, we want to be roughly in a two times net leverage. So we feel we're on the right path, kind of de-risk, if you want to say so, and use the balance sheet to the levels where we want to have it.
So appreciate, covered so much ground as you always do. Marc Bitzer, be well. Look forward to always our next conversation. Chief Executive Officer at Whirlpool.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Well, shares of Apple now up by 0.3%, reversing an earlier decline. This after a Bloomberg exclusive by our own Marc Gurman that reported that Apple is canceling the car project, its electric car project, and shifting a team to generative AI. We got Marc Gurman right now, Bloomberg News chief technology correspondent, live from our studio in Los Angeles, just moments after publishing this. Marc, a collective wow came out of the newsroom when we saw this story cross here. I mean, this is a project that the company's been working on for a decade at this point. What do we know about Apple's electric car plans?
Yeah, so Apple this morning officially canceled work on a self-driving electric car. Jeff Williams, the company's chief operating officer, and Kevin Lynch, the company's vice president of technology, who was foremost in charge of the car project, announced to the team, it's about 2,000 people, that the project, called Titan internally, is winding down. There will be layoffs of some hardware people. Hardware people will have the opportunity to apply to other teams. Other people working on the project are being shifted to Apple's AI and machine learning division to work on generative AI products, a key future component of the company. There will be some people moved to the Vision Pro as well, with that focus on spatial computing. But this is a bombshell development. This is a very rare retreat for Apple. This is a project that they've invested over $10 billion in. They've worked on it for over 10 years. It's had many fits and starts. It's had many directional changes. About a month ago, we reported that Apple had reached a make or break point for the car project. We reported that the latest incarnation of the project, after several meetings with the company's board of directors, was a new budget around a level 2+ car. That was a downgrade from the original vision of a level 4 or a level 5 fully autonomous vehicle, and they also pushed back and delayed that. Since then, there have been more discussions, and executives made the final decision earlier this month, I'm told, to completely shutter the project. So again, this is Apple canceling work on an electric car. This is a significant development for one of the company's most ambitious attempts at a new product category in its history. So this is a very significant day for the company.
Yeah, very significant. It's not like it's just, an idea on the back of a napkin. I mean, they had been pursuing, as you said, Marc, for over 10 years. The road was rough, though, in Apple's pursuit in terms of bringing a car to market. I mean, this company, for them to step up the amount of time, money, people, effort that they have put into something like this, I don't know. How do you get your head around it? Does it mean just completely done? Does it mean that they could buy into something in the future, or they're just saying this isn't a market for us?
Certainly, there are considerations on the table to acquire an existing car maker. Obviously, you've seen what's happened in the car industry lately. Rivian has not been doing so hot. You've seen other car companies struggling, Lucid being one. Tesla has had its own ups and downs. It's a very, very thin profit margin business. It's not the typical business that Apple likes to get into, but there is some risk in abandoning this project. What if Alphabet, Google, Waymo, Amazon with Zoox, some of these other big technology companies, certainly the Chinese phone makers, they're all getting into cars. What if one of these companies comes up with a great car idea one day and successfully creates a new ecosystem of its own to rival Apple's, and they can risk pulling people away from Apple into a Google car or an Amazon car and getting them on their other products in the ecosystem. So there's certainly some very long-term risk here, but in the short term, this may be a good thing for Apple, being able to focus resources towards perhaps more promising areas in the short term, like spatial computing and generative artificial intelligence.
Well, that's exactly where I wanted to go with you next, Marc. To you, is this more about Apple saying no to a car and less about Apple focusing resources on AI, or is it the other way around here? Is it all about Apple saying, wait a second, the rise in interest in generative AI over the last 18 months has just been massive, and we need to go all in on this such that we need to actually cancel our work on the car in order to do that?
It's certainly not the latter, Tim. This is Apple making a decision to wind down the car project because they weren't getting anywhere. It kept getting delayed. It kept getting more expensive. They have these hundreds and thousands of employees that are brilliant people, and we have places for them. Generative AI is a key area. Let's throw them there. There's a lot of artificial intelligence, machine learning overlap between work on an autonomous vehicle and what needs to be done for the future of AI on phones and watches and earbuds and glasses and such. So it makes sense to reallocate those resources. But don't be mistaken, this is a decision all about canceling the car. They just happen to have an excellent soft landing for the resources that have been invested in the vehicle project.
Okay, so if you're an investor in Apple and you're saying to yourself, I'm a little concerned about the decline in iPhone sales in China. I'm a little concerned about the traditional Apple products being long in the tooth here. I don't necessarily see promise, at least right now, in spatial computing, Marc. What is there on the horizon for these investors to get excited about? Because I think on a lot of minds have been, okay, well, at least Apple's working on a car here, and that'll be out at some point.
Certainly the Vision Pro is something that Apple is focused on. That is a big new category for them. And certainly generative AI, AirPods with cameras is something I wrote about, the eventual debut of augmented reality glasses. There are certainly other things on the roadmap that could be exciting, but nothing that would drive as much immediate revenue as a $100,000 car.
Yeah, talk about it, right? That really moves the needle. It's a whoa moment, as we say, but another exclusive by you, Marc, that's really got everybody kind of rethinking some of what Apple's doing in the future. It's just a really, really big deal. I will say Apple's shares still up about 0.5%, but nonetheless, really interesting when it comes to Apple's strategy. Marc, thanks so much for jumping in and telling us about your exclusive. Of course, Bloomberg News Chief Technology Correspondent Marc Gurman joining us out there from the West Coast.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Another one of our most read stories on the Bloomberg throughout the day, and that is what companies are doing when it comes to raising capital. It is today's Bloomberg Big Take. It is, as I said, one of the most read stories. It is how companies have adapted to this high rate environment that we're seeing and what they're doing instead of issuing debt. So let's get to this story.
Yeah, that story by Sujata Rao-Coverley and Bailey Lipschultz. Bailey Lipschultz is with us now. He's equities reporter for Bloomberg News. He's here in the Bloomberg Interactive Brokers studio. So companies for years, Bailey, when they've wanted cash, when they've needed cash, by the way, congratulations on the big take.
Oh, thanks.
Very cool.
Yeah.
Very cool. When they've wanted cash, when they've needed cash, they've gone and raised debt because rates have been low. But here we are in a higher interest rate environment, the highest rate environment we've seen in decades. What are they doing instead?
Well, now we're at least seeing this take hold across the pond in Europe. It's becoming something that we've been really tracking over the last 5 months since this story was something we started to track. And they're selling shares. So whether that's straight up equity through a secondary offering where they create new shares and dilute some of their existing shareholders, or convertible debt, which has been really kind of a big trend here in the US in particular. So we've been seeing a lot of equity-linked assets being sold as opposed to, as you mentioned, Tim, straight up debt that was, for the most part, if you're a blue chip, essentially interest rate free.
Yeah, totally get it. I mean, the other thing is, though, I always do think when there's shares being offered up, the dilution, though, that's got to be an aspect that some investors are going to maybe look down upon.
Yeah, well, when I spoke to Myriad Genetics CFO back in November, they raised $110 million through a secondary offering. And he basically said they spoke to some of their largest shareholders and said, we want to clear out our debt. We want to handle a lawsuit. What do you prefer? And he said at the time, interest rates for them was north of 10%.
Yeah,
so they said the math didn't add up. It's easier to just kind of sell some equity, take the dilution, and then move on.
That's interesting. Go ahead.
I do think what's interesting is companies are figuring out how to kind of manage their way, right? We're so concerned about the debt on various balance sheets and whether or not companies are going to be able to manage it. This is kind of a way out, right, for them to deal with it, especially as we continue to talk about the Fed keeping rates higher for longer.
Exactly. And this has been something that, again, we started really digging into this back in November. Back then, we had, 6 interest rate cuts priced in for the Fed. Now we're closer to 3. So as these kind of higher for longer rates continue to play out, and you don't see the Fed and central bankers around the world acting as swiftly as many had hoped, it is something that boardrooms and CFOs have to think about.
What is interesting, though, too, is that, a couple things come to mind, Bailey. One is that really in the last few weeks, in the last few months, we've seen a lot of companies do stock buybacks in the most recent earnings period. So if a company has done stock buybacks, then it has more stock than it can then sell. So, right, it's the opposite of dilution. The other part of this, Carol, this is what I was thinking about, is, the news recently about the Walton family selling shares of Walmart close to record highs. Jeff Bezos, for the first time in years, selling stock. Jamie Dimon, for the first time ever, selling stock. Mark Zuckerberg, for the first time in 18 months, actually selling stock. All of this happening as the share prices go higher.
Yeah, it is kind of interesting. I kind of get it. Some of them, it's just probably financial management in terms of
they always
their
seem
wealth.
to know when to sell.
What I do find interesting, Bailey, though, is we've also had folks come on and talk about how companies are also tapping the debt market at the same time. Is there something specific in terms of the size of a company, the types of companies that are tapping more the equity side of things? And I'm assuming it's on the smaller side, but you set me straight and set the rest of us straight.
No, typically smaller companies. Again, that's why I said it's kind of stressed. It's very much taking ground in Europe because of different dynamics that play out there versus the U.S. because of the makeup of some of those companies. When I was talking to Paul and Tom this morning, they kind of said, Apple sells debt to buy back stock, and Apple is its own beast. These are big companies. If you're looking at your true Magnificent Seven or some of the biggest companies, I'm thinking of like a Pfizer where they can sell stock.
Tom and Paul, get real. I'm not talking about Apple.
Exactly. And these aren't companies necessarily that need the stock, need the cash. But to your point, though, one thing that kind of plays into it, when these big shareholders are selling down stakes, it's kind of in a way plays back into that re-equitization trend, much like private equity selling, because now you have more shares that are out there for people to trade and sell. And so when you have a company maybe waiting to go public via IPO like Amer Sports, you basically have kind of a consortium in private equity that will at some point exit that stake, which means more shares for the general investing public to buy and sell.
Do you think we're going to start seeing it happen more in the U.S.?
I think it depends. IPOs, yes. I write about IPOs and secondaries without a doubt. I do think, based on some of the reaction reception I've had from clients, is that this is a trend that we're early to write about, and it's something that in the next few months, next 6 to 9 months, we'll really have a better sense of, did that play out or didn't it play out? Back to the point of the Fed not cutting as quickly as people were expecting. Because if yields stay where they are and the Fed stays where it's at, that kind of will have kind of a knock-on effect.
I just think it, again, going back to what we talked about already, but I just think it's interesting because we get concerned about whether or not companies are going to be able to manage the higher debt costs on their balance sheet. And so what do? Are they able to renegotiate that debt? Are they able to go back to the debt markets and get new issuance at lower rates? I mean, they've got to figure it out. But this is like a clean way out of it, if there's interest in their new equity issuance, right?
Exactly, and that's for both public and private companies. It comes back to the idea that a lot of private companies, former unicorns, want to go out. They just don't want to kind of rip the Band-Aid off on valuation, but that's a way to really reset your cap table, pay off some debt, and be able to try to function and at least stay operating. Otherwise, you're going to be sold probably for bits and pieces.
Right, expands the runway for them.
But in a perfect world, no question that, in a low interest rate world, no question that investors would prefer tapping the debt markets than actually, selling stock.
Which is why when you look at companies that typically sell equity in the public markets, it's biotech, it's life sciences, it's companies that need cash now, and investors who bought in Series A through the IPO know that they're going to continue to get diluted. They're just hoping that the upside is high enough. But if you're a company that's cash flow positive and you're profitable and meeting your metrics, zero interest rate market, they'd rather sell debt because you're not getting diluted out of that.
So as somebody who watches the markets and is watching this trend, what are you going to be keeping an eye out for to see if there's some momentum behind it?
We'll be watching secondary sales, private equity selling down, which is, again, a form of that re-equitization trend. A lot of stocks are trading at or near all-time highs, or at least well off of levels they were at this time last year, even at the end of last year, as well as the IPO market. Hopefully I will be busier writing about IPOs, and that just means that this cycle, this kind of push and ability for companies to go public, tap public equity investors, is going to be playing out.
All right, Bailey Lipschultz. Bailey is equities reporter for Bloomberg News here in the Bloomberg Interactive Broker Studio. Check out his story. It is today's big take, among the most read on the Bloomberg terminal. And for more, you can go to bloomberg.com/big take.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, everybody, just about 18 and a half minutes left in today's trading session. Charlie, of course, breaking down the trade here. It's kind of a muted trade, safe to say it. Although on the Treasury, if we look at the Treasury trade, we've definitely seen rates move up. We've got some economic news that we've gotten this morning. We've had some Treasury auctions. It's, again, a busy week here. But again, a little bit of a muted trade here ahead of a key inflation report and also a lot of Fed speakers, and then Jay Powell next week.
Yeah, there's a lot happening right now.
Yeah.
And still, earnings are still happening too.
A little bit of earnings, right? Yeah.
Very pleased to have with us Adrianne Yamaki, founder and financial advisor at Strategic Wealth Capital. This is a firm that focuses on clients who have a net worth of above $5 million, or I should say portfolios above $5 million, income above $500,000. She joins us from San Francisco. Adrianne, good to have you with us. How are you?
I'm great. Good to talk to you.
Hey, what are your clients coming to you with right now? What's concerning them? What questions do they have right now?
They're asking a lot of good questions about what we hear so much about the Magnificent Seven and NVIDIA. So there are a lot of large cap US companies, specifically in tech, that are making headlines. So clients are very curious. Are these the companies that we should keep focusing on? Or are there other sectors and industries, and globally, are there other things that we should be looking at? Which I think is 100% exactly the right question. So one of the things, for example, we've been talking a lot about is interest rates, whether they start coming down in the next couple of FOMC meetings or further out. We know that whether we hold tight a bit longer, we're still going to see rates dropping. And with that comes a lot of opportunities in specific industries. So we're talking quite a lot about how does that change the landscape, and then how can you position a portfolio in the longer term to take advantage of that?
Well, so having said that, talk to us a little bit about the clients that you work with, Adrianne, and I'm just curious about kind of, from what I understand, I'm guessing that they have really long-term objectives and capital preservation is probably top of mind. But give us some background and give us an idea of some of the opportunities that are kind of top of mind and that you guys ultimately kind of focus them on.
Yeah, absolutely. We're very lucky in that our client base has built a certain level of wealth. They have high income. They happen to be in higher tax states. So DC, New York, Virginia, California, and capital, while their incomes are still very high, and most are senior executives and they're still working, there are a few commonalities. One is that taxes are very high. So doing a lot of the tax planning is important. And then secondly, as you said, Carol, they tend to look longer term, which is, for a financial advisor team, is excellent, because that helps us, for example, position. We don't worry about the next trade or what technically is going to happen in the market. because that's often the price, as we know, of a stock is often is divorced from the underlying earnings of the company. But over time, and that's why holding long term, it sounds very overplayed, but it's still 100% correct that over time, the price of a company regresses to the earnings. So because our clients look longer term, we can look very much at what are you paying for the stock? What are you paying for the portfolio? And because of that, it opens up a lot of opportunity. So as I mentioned with interest rates, as rates kind of hold steady and start to come down, financial services and is one industry that benefits quite a lot from lowered rates. So not just mortgages and business loans, but the way that the banks lend and net interest income and how they make their money benefits a lot from lower rates and the type of environment in which that happens.
Adrianne, where do you not want your clients to be right now?
I think that that's a good question. If we look at where we've come out since COVID and the risks that collectively investors, individually and institutionally, have been taking, a lot of it's been focused in the US. There's such a heavy bias. There's a really interesting Wall Street Journal article a couple of weeks ago about that as well, that it's not just individual investors with a strong US bias. It's also professional institutional investors. So one area we are increasing in clients' portfolios is abroad. They're great blue chip companies that just happen to be based not in the US. Nestle, there's so many and I can't specifically give recommendations or not for a specific stock, but if we think about globally, what types of companies are also multinationals, happen to be based elsewhere, have strong portfolios in and of themselves, we can see how much breadth and robust revenue there is. That's not something we hear every day from the S&P.
I am curious, as you say, there seems to be a lot of interest in the U.S. market, and I get it, considering if you look at kind of around the globe, the U.S. economy versus a lot of other economies. Having said that, we get a lot of folks, or I feel like an increasing amount of folks, Tim, right, that are coming on and talking about what's going on in Japan specifically and the opportunities there. We had some data, I think, overnight about Japanese inflation topping forecasts. So maybe the BOJ starting to, in terms of increasing rates. Are you finding opportunities in Japan for your clients?
One thing that I always tell clients, and I think it can feel counterintuitive, is it's really important to separate the economy and the political environment of a country from the investments from the public companies which are based there. So for example, in Japan, there are certain demographic patterns. They have an older population. As you said, inflation is a concern. And when we think about productivity, I think Japan isn't where we initially consider in terms of higher growth. We think of BRIC countries, for example. On the other hand, when we look at specific companies, I'm curious for you guys, what do you drive cars? And if you do, who manufactures your cars?
Yeah, Japanese company for mine.
German company for mine.
Ah, excellent. But see, exactly. Both of those are abroad. And Japan and Germany, it's interesting. They both...
I will say my car is manufactured in the US, even though it's a Japanese company.
Who gets the revenue? Probably part of it comes from the US in the parts. And the full vehicle is that revenue is attributed to Japan, to the Japanese index.
Interesting.
So
we unfortunately have to run, and I know we've caught you in the middle of a thought, which just means you're going to have to come back, and so we can continue this discussion. Adrianne, thank you so much. Adrianne Yamaki, founder and financial advisor at Strategic Wealth Capital, joining us from San Francisco.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube. and always on the Bloomberg Terminal.